In this video, we learn about assets, liabilities, and owner's equity. Assets. It includes everything that the business owns, like cash, inventory, and equipment or building. Now, let's talk about what liability is. Liability is everything the business owes to others. That means a loan or accounts payable. You have bought something but have not been paid yet. So that becomes a liability. Now, then what owner's equity is? The owner's claim on the assets after liabilities are paid off, like capital invested or the retained earnings. Now let's talk about the types of assets. Assets may be of various types like current, non-current, tangible, intangible, financial, operating, and non-operating assets. Let's talk about current assets. Assets which are expected to be used, sold, or converted to cash within 1 year, like cash, accounts receivable, inventory, prepaid expenses, and short-term investments. Non-current assets. Assets that a company expects to use for more than 1 year, like land, building, equipment, vehicle, furniture, and machinery. Tangible and intangible assets. Tangible assets are machinery, building, land, vehicle, and inventory. On the other hand, intangible assets are difficult to be pronounced in terms of its monetary value, which are normally like brand, copyright, goodwill, knowledge, or the patent. There are more three types of assets, which are financial, operating, and non-operating assets. So financial assets are self-explanatory like stocks, bonds, bank deposit, accounts, receivable. On the other hand, operating assets are the assets which are used for day-to-day business transactions and procurement and production of products. These are inventory, machinery, raw materials, and cash. On the other hand, non-operating assets are those assets which are not essential to core operations, like a vacant land which is not being utilized, long-term investment, rental properties, and bond. Now let's talk about the liabilities. What is a liability? What a business owes to others, like debts or obligations that arise during a business operation and are settled over time through the transfer of either money, goods, or services, are called liabilities. So in simple term, we can say that liabilities is the claim of creditors on the company's assets. It may be in terms of money, goods, or services. Now let's talk about the types of liabilities. Liabilities are basically of two types. One is current liabilities, which will be due within 1 year, and another is non-current liabilities, which will be due after more than 1 year. Current liabilities are accounts payable, short-term loans, wages payable, taxes payable, and unearned revenues. Whereas the examples of non-current liabilities are long-term loans, bonds payable, lease obligations, and deferred tax liabilities. Let's take an example of liabilities. If a company takes out a loan of $50,000, it increases its cash. That means its assets are increasing by $50,000. Henceforth, as it is being taken on loan, its liabilities also increases by $50,000. Let's see another example. Money received in advance from the customers for products or services to be delivered later. So if we explain this further, a customer pays $1,000 deposit for custom furniture that will be delivered in the next month. That means $1,000 is a liability until the product is delivered. Now here the liability is the product, not the cash. We see another example. It is called accrued expenses. These are the expenses that have been incurred but not yet paid, like salaries earned by the employees but not yet paid at the end of the month, utility bills that have not been paid yet. Now let's talk about the owner's equity. Owner's equity, also called the net assets or shareholder's equity in the corporation, is the owner's claim on the business assets after all liabilities have been paid off. So if we see the simple equation like owner's equity equal to assets minus liability. Now let's take an example. If a business has total asset of $100,000 having a liability of $40,000, then if we subtract $40,000 from $100,000, we get $60,000, which represents the owner's share on the business. That means the owner's equity. Similarly, if a new business has started with a capital of 90,000 US dollar and where the transaction has not started yet, that means there is no liability. However, if we subtract this 0 from 90,000, that means the entire 90,000 is the owner's equity. I hope you have enjoyed my today's video. Hope to see you later. Thank you.